All right, let's dive right in. Today, we're talking about one of the most powerful and honestly, one of the simplest principles in all of investing. Think of it as your ultimate safety net, a cushion that protects you from the chaos of the market.
But first, let me ask you something. When you buy a stock, are you really, truly sure you're paying the right price for it? Or maybe a better question is, are you paying a safe price? It's a really tough question, right? And it's the exact problem that this whole idea is designed to solve.
So let's start with the big why. I mean, why do you even need this cushion, this safety net in the first place? Well, because investing, just like life, doesn't always go the way you plan.
Look, it doesn't matter how much research you do. It doesn't matter how brilliant your spreadsheets are or how confident you are in a company. The fact is, every single investment you make has some level of risk. The future is, well, it's unknowable. And because of that uncertainty, we have to be prepared for things to go sideways.
So what exactly are we protecting ourselves from? Well, a few big things. First, it protects you from yourself, from your own simple calculation errors. Trust me, it happens to everyone. Second, it shields you when the entire market takes a nosedive, something you just can't predict. And finally, and this one is huge, it protects you from the hidden danger of paying fair value. Paying what something is worth today leaves you with absolutely zero room for error if anything, and I mean anything, goes wrong.
Okay, so we've established why you need this buffer. Now let's get down to it and define exactly what this margin of safety really is.
Here it is, plain and simple. The margin of safety is the idea that you should only buy an asset, like a stock, when its price on the market is significantly lower than what you've calculated its true underlying worth, its intrinsic value, to be. You see, it's not about buying at a fair price. It's about hunting for a real bargain.
And this quote right here, it just nails the entire philosophy in one single sentence. Forget about paying what something is worth. The whole game is about paying way, way less. And that one simple rule is really the foundation for building a truly resilient portfolio.
So that's the theory, which is great, but how does this actually work in practice? Let's put some numbers on the board and make this crystal clear.
Okay, let's imagine you've done all your homework on a company, and you figured out its intrinsic value is about 500 rupees a share. That's what you believe it's really worth. Now, instead of rushing in to buy it at $500, you wait. You set your target buy price much lower, maybe somewhere around $350.
And that gap you see right there, that space between the true value and your purchase price, that is your margin of safety. It's your financial cushion. It's your buffer against bad luck, bad timing, or just a bad calculation on your part.
In this case, that price difference gives you a solid 30% margin of safety. Now, what does that actually mean? It means the stock's price could fall by almost a third from its true value before you would even begin to lose a single rupee of your original investment. I mean, think about that. That is an incredibly powerful position to be in.
Okay, so we know what it is, we know how to calculate it. The big question that's left is, when on earth do you find these opportunities to buy at such a huge discount? Especially in a market like India's.
You know, the best time to go bargain hunting is almost always when everyone else is panicking. During those periods of intense fear or uncertainty or big market corrections, people just start selling everything, often without thinking. And that's what pushes the prices of even fantastic companies way below what they're actually worth.
And this is where it gets really interesting. During those big market corrections here in India, it is not at all uncommon to find amazing, high-quality stocks trading at a massive 30, 40, or even 50% discount to their real value. So while everyone else sees a crisis, the disciplined investor, well, they see a once-in-a-while opportunity. So look, if you only take one single thing away from all of this today, let it be this. Don't just invest. Invest with a buffer. Always demand a discount. Build that cushion for yourself, and give your portfolio the strength it needs to handle whatever the market throws at it.
And that really leaves us with one final thought. I want you to go and take a hard look at your own investments, at your own strategy, and just ask yourself this question. Is my portfolio truly built with a margin of safety?